With more than 6,000 small and microcap companies listed, if you're looking for the next apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and microcap data place. Welcome to the virtual Roadshow series presented by ChannelChek. This Roadshow features Doug Bartole, President and CEO of InPlay Oil, OTC ticker symbol IPOOF, TSXV ticker symbol IPO. Following a formal presentation, he is joined by Michael Heim, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed SEC-registered broker-dealer, for a Q&A session featuring questions that were submitted by the live audience. You can find Noble's research on InPlay Oil on channelchek.com or by clicking the link in the description. With that, I am pleased to present Doug Bartole.
Well, thank you. It's a pleasure, everybody, to be speaking to you here today. We've had some great news releases in the last month since we did the C-suite interview with Michael. And again, I'm just pleased to say operationally things are tracking solid, coupled with the great news of our senior credit facility being renewed on a fully conforming basis. It's just actually been a remarkable turnaround from where we were a year ago. So with that said, I want to jump right into our presentation. Oh, that's great. Well, there we go. You know, we're very proud of the fact that we're a technically focused management team operating a sustainable light oil growth company. It's been a challenging environment. 2020 might have been the most challenging environment of my career, but in the same light, I think we've come out of the back end of that looking very, very strong, probably in the best position we've ever been as a company. We're positioned in two very exciting light oil plays in Western Canada. I'm going to really focus on the Cardium play. That's our focus right now. That's our growth story. That's 90+% of our company. We have consistently grown our production since we went public late in 2016, every year, except of course in 2020. We're going to talk about that, all within our funds flow. Now, in 2021, we're forecasted to grow again significantly, and not even to the fact where you know, our original guidance was 51 to 5,400. We're now projecting to be on the high end of that guidance, and depending on a few pieces, you know, it potentially could exceed that when we put our release out in August 11th here, when we do our Q2 release of our financials and operating statements. Again, significant growth, lots of free funds flow that's going to be used to pay down debt. So both debt and will be lower than pre-COVID levels potentially by the end of the year, and cash, our funds flow will be higher than anything we've ever done, coupled with the fact that we're going to hit the high end of our guidance or better, which is record production for us. We're very capital efficient, and I think that's a key to thriving in today's industry. The access to capital, whether in equity or debt, is still difficult. With that said, we are finding reserves, barrels in the ground at the top of our light oil peer group. We're adding production on a producing barrel level, again, at the top quartile of our peer group. All of these are important in running a sustainable company as we move forward. So we got back to business after a very difficult 6, 7, 8 months in 2020. It started by getting a 4-year term loan, second lien at reasonable interest rates. That allowed us to get back to our capital program, getting our production on. And as I mentioned, now we've renewed our senior credit facility to be fully conforming. So that puts us in a fabulous position. We've been a disciplined consolidator over the years of these tuck-in acquisitions, and the one we did late in 2004 has been phenomenal. We have now put about 12.7 million into that, including the acquisition price. We're currently producing over 1,700 BOEs a day. That works out to about 7,500 a flowing barrel at this point in time. Exceptional results coming here. Are we better than ever? I would say, yeah. That acquisition and a few other things, the efficiencies we've accomplished, have put us in a great position. We're sitting here, we drilled 3 extended reach horizontals, 1.5 milers at the end of Q1, got them on production. They are completely exceeding our forecasts. We have record production in the second quarter of this year. We expect that to continue through the second half of this year. We had record reserves at the end of 2020, which is a phenomenal feat considering the drop in commodity prices, the lack of capital spent, and most of our peers actually had decreases in reserves, other than the fact, unless you diluted your share count. So we were able to do that without any dilution. We are executing on all of our plans, measured growth, free adjusted funds flow, paying down debt, getting back to those pre-COVID levels, and even stronger. The liquidity we talked about with the senior facility puts us in a great position to execute on our strategy and provide very, very solid returns for our shareholders. Really quickly, I'm going to get in. We have about 68 million shares outstanding. At $1.40 Canadian, that's about 96 million of market cap, 175 enterprise value. So a great big turnaround in the last year, and really since the beginning of this year. Our liquidity has increased. The last 6 months, about 220,000 shares a day, closer to 300,000 in the last month. So again, a lot more interest with us, a lot more interest in our industry. And I'm seeing it with the amount of Zoom calls that I tend to be doing here lately compared to 3 months ago, and virtually none 6 to 9 months ago. I'm going to not spend a lot of time here. Our management's a technical team, value creation team. We've got a strong board of directors. All of our information is on our website at the back of this presentation. So feel free to view that at leisure there. This is always my favorite chart. This is our growth. And when I take a look at when we went public in 16, the light green being our light oil and natural gas liquids, and the orange being gas, growth year over year, except for in 2020. The blue is our growth on a production per share basis. And we are now looking at being at the high end at a minimum, so 5,400 BOEs a day. Solid growth on a production per share basis. Reserves, proved developed producing reserves. That's just a blowdown case of our current producing reserves. Purple, proved reserves, total proved. That's starting to add some undeveloped locations. And the orange is proved plus probable. That's starting to add more undeveloped locations and potentially a little more risky at this stage. We have grown reserves in all 3 categories since our inception. Again, a remarkable feat, specifically in 2020, which was a very, very difficult year. Back to the capital efficiency portion of things. In 2019, our PDP, proved developed producing, finding costs and recycle ratio versus our peers. We had a significant group of peers back then. On a PDP basis, we were number 2 amongst these peer group, and we have them all, these peers in the bottom of this chart at this note. Our proved, we were number 1. So again, at the top of our peer group. When you go to 2020, we were number 1 on proved developed producing finding costs. We were number 1 on total proved costs of our light oil weighted peers. We had one company that sold through that time, so we lost it. But there were many companies that were not able to show positive finding costs. They were negative finding costs due to revisions in reserves and the pricing. So again, we are adding barrels very, very efficiently. Environmental stewardship, we are dropping our greenhouse gas emissions every year. We are doing our part. We're working towards what needs to be done here. Of course, 2020 was a little more difficult. We had less production and less ability to do things there and put capital towards reducing emissions. But we expect to be back on a high single-digit, low double-digit reduction in emissions as we continue to move forward here. We are spending 4 to 5% of our funds flow. And that's why I like to use adjusted funds flow, because that's what's needed to do for all of our business. But adjusted funds flow includes decommissioning. And we are spending 4 or 5% of that to decommission existing facilities and wells on a yearly basis. So again, doing everything we need to do on that front. So let's get back to operations. We're in Alberta, head office in Calgary. The Cardium, which is over 90% of our production, is a 2.5-hour drive northwest of us. High end of our guidance, 5,400 BOEs a day. How do we generate these top tier light oil growth, which is now still top tier, and the significant free funds flow we're generating? That's because we have a low decline light oil weighted production base. we've got high netbacks, and we've got economic quick payout inventory. That's what's providing that top tier growth. On the right, the purple bar chart, operating income profit margin. You can see since 2016, we've been increasing that profit margin every year. 2020, obviously a very difficult year with WTI just under $40. That's what's in the blue bar on the right side of the chart. So again, we're still using the $60.50 forecast from our that we put out here earlier in the year, but our margins are now projected to be over 60%. And this is all part of the efficiencies that we've done over the past few years. You know, it doesn't matter what business you're doing, if you can increase your operating margins, that's a significant piece of business, whatever kind of industry you're in. And I consider that to be a core piece of where we're going and how we're going forward. Even with commodity prices declining at times, we've been able to hold or maintain those efficiencies. Let's take a look at Pembina. This is the biggest, oldest conventional light oil pool in Western Canada. It's been around since the 60s and 70s. We've been drilling industry pace-setting 1 mile horizontal wells. And you can see in this bottom chart, this is us versus the peers. You can see the InPlay emblem. All 6 of the wells we drilled in Q4 of 19 and Q1 of 2020 are on this chart. 5 of them are in the top 9 fastest ever drilled. The top 3 were under 4.3 days, and they're all InPlay wells. Time is money. This is what we've done consistently in most of the plays we've gotten to. Our focus allows us to keep making changes, technical changes, and to reduce the costs and reduce our payouts, specifically when you have increasing commodity prices has really been a big key for us. The 6 wells we drilled in Q4 of 19 and Q1 of 20 are plotted here against the dashed line, which is our type curve. You can see we curtailed these wells, which are the stars in Q2 and into early Q3 of 2020 due to the low prices from the demand destruction with COVID. The funny part is this type curve average IP365 or 1 year is 100 BOEs a day. And even with the curtailments, we did 143 BOEs a day, which is 43% higher than our type curve. We've had consecutive 2 years in a row reserve increases, and we're expecting that similar thing to happen, or that similar event to happen in 2021. Oh, the recent Pembina acquisition. We purchased this for $1.9 million. We got on there in the first quarter drilling 3 1.5 mile wells in the Northwest here, which we've recently released the results. We have now just finished, as of this morning, moved the rig off the 3 directly offsets to the south here of 1.5 mile wells. This has been a great acquisition. Contiguous land base allows us to drill longer than 1.5 mile, potentially 2 mile wells here. It's 100% working interest. Crown land, so cheap royalties. The development pace and program is well within our control. It's been low decline. This first group of wells are flowing. And let's take a look at that chart here. We brought them on at the end of March. The black line is the average. 1 flowed from day 1. The other ones we had to put pumps on just due to the imminent of breakup, but we pulled them off at the end of April. These wells have now been flowing since, with the black line being the average. The yellow line is the forecast we've been using in our current model. The blue line is the total proved reserves we got at the end of the year from our external reserve evaluators. And the red line is the total proved plus probable, significantly outperforming that. Something like 100% above our total proved reserve number at the end of last year. So again, we knew this would be a good property. We just didn't know how good it was, and completely exceeding everything we thought would happen here. We also built a battery right up in this area at the beginning, or in the first quarter of this year as well. And that battery is now set to be able to handle the full scale development of this whole southern part of this project. So that's our third one that we've done like this. Very efficient at building those as well. Willesden green, our land's in yellow. You can see the horizontal wells. The light green are the vertical wells. Still got lots of opportunities here. This is what we like to show of how we do things. It's our project economic focus. We like to develop everything as a full cycle project to cut costs and create efficiencies. We drill 2 to 3 wells at a time from pads, limit the environmental footprint. This was our first modular multi-well battery we built to handle the full field development. Very cost effective at only $124,000 per well. Let's get into the type curves and the economics. And I'm just going to focus on payouts. Here's the 1.5 mile wells we've been drilling in Pembina and Willesden Green. We like to drill those 1.5s whenever we can. We think they're much more efficient. We got $50, $60, $70 pricing. Let's just focus on our last 3 wells on the acquisition, the 1.5 mile wells in Pembina. At $60 WTI, we're about 0.7 of a year payout. In the first 90 days above our type curve, we're around 20%, 21% higher above the cum production over that days. That's why we believe we've been saying that at $60, we're seeing a half a year payout, because those wells are currently exceeding the economic type curve we're using in this presentation. But all in all, once you get to $70, the majority of these wells are paying out in a half a year. I'm not going to spend a lot of time here. You know, the WTI oil price average for the year that we put out a few months ago is $60.50. To put it in perspective, it was $62 at that time on strip pricing for the second half of the year. It provides us, when you do the exchange, at about $71.50 of Canadian par pricing. What I want to talk about is next. I'm going to give you some sensitivities. Now, the majority of our 2020 hedges that we put in place rolled off at June 30th. This is going to result in significant increase to anticipated funds flow in the second half of this year and beyond. So for the pessimist, I got $60 for the second half of the year. And if you remember on the last slide, we had $62 in our current forecast for the second half of the year. So this is just second half of the year. I put in 70 and 80, and the price strip future price here was 73.65 on Monday of this week. You can see the Canadian dollar per barrel price we get and the exchange rate we're using. And we're using $3 a gigajoule of AECO gas price. As of Monday, it was $3.50 on strip pricing. So still conservative on that front. But the real key is our second half of the year funds flow. Let's go to adjusted funds flow. You can see at the different pricing. So about $30 million in the second half of the year, which is about $61 million annualized. That's close to 90 cents per share at 68.3 million shares outstanding. Now, even at the low case, we're looking at another 27 million. Any way you look at it, we're close to double what we generated in the first half of the year with the hedges rolling off. And we are currently completely unhedged going into 2022 right now. We have mentioned a few times too, we are now well ahead of where we planned or thought we would be on net debt to EBITDA. And you can see we now get to 1 or below at any of these price decks when you annualize the second half of the year funds flow that we expect to receive. And that's using 5,400 BOEs a day, the exact high end of our guidance. So again, things have changed quickly, remarkably, and we are in a fabulous position as I see it right now to continue to execute on that strategy. I'm going to just change pace a little bit here. As you can see, we're doing fine at $60, $70 WTI. But what does the oil case, the bullish case, look like? If you go back to 2011 to 2025, this blue line is days of U.S. inventory and commercial oil stocks. 20 to 25 days is the top and bottom of these lines. So this is from my friends at Athena Capital here in Calgary. When you hover between that 20 and 25 days, oil hovered between 80 and as high as $110. Now you can see when the inventory worked its way up to 30, 35 days, we got down to, what is that? It's about $45, $50. You can see when inventory during COVID peaked at over 40 days, we got down into the 20s and $20 to $40 WTI. This has been increasing. The oil price has been increasing as the inventories dropped. As I mentioned earlier, we had another massive 12.5 million barrel drop in inventory from commercial stocks here today, plus 6 million of gasoline. Where does it go? I don't know, but where we sit today looks like it's a pretty solid spot in that 70, at least at a minimum, the $70 range, which we can just run a fabulous, smart business in those type of pricing environments. I'm going to conclude here. Again, strong technical management team, value creation team. We had an aggressive response to the COVID pandemic. We're now positioned for continued top-tier growth. We're in a financially strong position, as strong or stronger. We have not been below 1x debt to cash flow in many years, and we're looking to be there soon on anything on the strip price forecasting. I think we position ourselves for more of these disciplined tuck-in acquisitions. We're a very strong operational technical team. I think we've been leading the way in technical changes in the Cardium, best-in-class operations, driving those costs down, which I have said over and over is a key to thriving in the oil and gas industry, because I think it has fundamentally changed as we move forward. I'll end with that, and I'll let Michael take over from here and ask any questions.
I want to start out with these terrific results on the last 3 wells, and specifically what I want to try and get a sense in is it just that we're hitting a good area with this acquisition you've done, or is it something you're doing, focusing on the 1.5 mile wells, or something else that might be transferable when we start talking about the other Pembina properties?
Yeah, that's a great question. So again, ultimately we thought the area would be really, really good. The last 6 wells we drilled in Pembina that were 1 mile, just due to the land that we had, exceeded our expectations. We saw similarities in this new play to that one. This area has had strong water flood support over the years, and that's kept the pressure up in both these areas that we're talking about. So that's why we thought it would be good. There's good pressure that's been maintained. Secondly, we're drilling deeper into much tighter sands, and the vertical production that occurred for 60 years in these areas really targeted only the top, more conventional sand at the very top. And with us drilling lower, we're accessing a majority of this crude and barrels of oil a day of product that was never touched before with a vertical well. And with the pressure keeping up, that's why we're getting these good results. Again, I knew it would be good. We were pretty pleased with it. It's completely beating everything that we thought we'd get out of it. I mean, you got to come and you got to put some risk on it when you forecast, and we thought we risked it well, and it's always a treat when even at that risk production everything looks good, but when you exceed it significantly, that even puts you in a better spot. So yeah, there's other areas that you can be bringing these qualities to, our technical expertise and everything else.
And I heard you specifically say maybe even going to 2-mile wells at some point. Are we talking the Pembina area again?
Yeah, if you actually look on that map, there's one area that bodes. I think there's about 3 wells that bode well to do 3-mile or 2-milers in there. So again, it's just how you can access it, from where you can access it surface wise. 2 miles I think would be our ultimate push in this area. With how we like to complete them and everything else. But again, most of the time it's just a land access. If you got 2 contiguous miles of property, you're going to use it. You're not going to drill 1.5 and 1.5. You either drill 2 ones or again, to get the most efficiency on the capitalized basis, 2 miles are the key there.
And your press release of a couple of days ago talked about redirecting attention or funds towards this area. So run me through the plan again. We've got 8 wells this year. We've done 3 of them already, and we've already announced the next 3 are going to be in the same area. And they following everything right, and then 2 more at the end of the year, which haven't been announced where they would be.
Yeah. So again, great question again, and then we'll finalize that come when we press release our quarter on August 11th, and we relook at all of our forecasts. So originally we had 8 wells. I think those 3 were the 1.5 mile wells in Pembina, plus another 2 more after that. We were going to drill 3 1-mile wells in Willesden Green. We've swapped that now for the 3 1.5 mile wells in Pembina, which we just finished drilling and we'll complete in the next week or so. And so we still have 2 1-mile Willesden Green wells on the books, and we'll make that decision after we bring the next 3 wells on here, and get a few weeks of production before we release new guidance in August 11th there.
So I heard a little bit of in your voice that maybe 8 isn't the ultimate number. I won't push on that, but let me ask the question maybe this way. You've talked about what the cash flow is doing here, and you've talked about paying down debt to get to that debt level of 1.0 times EBITDA. How do you not do more drilling when you've got these paybacks that are less than a half a year?
Well, I think we'll be disciplined for a while yet. That's why we partially want to wait, another month, I guess, a little over a month from now, get some more results. Let's get a feel where WTI is going. Like, it's still volatile. Like, we believe it's still in a great spot, but it's still volatile. I think ourselves and most of the other producers are still being very, very disciplined in the fact that let's get the market fundamentals kind of come together here. Let's figure it out. The demand seems to be coming back. We'd like to see it get back to those pre-COVID demand levels. We do have the variant concerns in a few places slowing down. Just as importantly, though, we want to see, before you get too aggressive, the OPEC plus barrels start to come back on the market and those being absorbed in the market. And I think that's a common theme with many of the producers. The discipline's still strong as far as we can tell. So we'll make those decisions. Every quarter we have a board meeting and we go through it, we talk about it, and we'll make those decisions and see where we go and how we change things through that time frame. But the most logical, if everything's going strong, would be to push off the Willie Green wells and to drill more in the new Pembina play. That'd be the first easiest step. But again, the goal is still reduce debt, to get back to that pre-COVID levels, which we can see line of sight to that now.
As you think of your different properties, is there importance to stay active in all of them for, I guess, market intelligence purposes, or are you comfortable with going 100% with what's hit?
No, yeah, good question. Market intelligence, we know what everybody's doing. The access to data in Canada is second to none. You got a lot of access to the data out there. So we keep up on everybody's activities all around us and even outside of our plays in some cases. But that's not a piece. You like to keep production up in certain areas, keeps the operating costs, flatter. You do have fixed costs, so with declining production, the fixed costs can have your operating costs creep up. We're focused on the light oil growth. We do have some gassier plays as well that typically are better off to drill going into the winter as you get that higher winter commodity price on the natural gas side. So that could be a timing thing as we look forward as well. But it's hard to move off of wells that are paying out in a half a year or better. Those are pretty efficient, effective wells.
You're leading me into a couple questions from the audience, so let me jump to that. And this one specifically asks, has there been an increase in activity in the Duvernay shale play? I guess talking about what you're seeing other people doing.
So yeah, in our appendix, I put it there for time's sake, the Duvernay slide. But basically, the areas around us are both private equity, private companies, private equity backed companies, and they have started drilling again. They typically got at least one rig going on a steady basis. So you're starting to see that activity pick up again. For us, again, it's still a long-term play. This year, we don't have a focus on it, but potentially next year, with sizable funds flow, that we'll start looking at doing things there again. But the activity has picked up significantly again, and a lot of the production in the area is back to pre-COVID or close to pre-COVID levels from these operators.
There's another question on hedges. I'm going to bring it in this way. You talk about the press release of a couple days ago, how a lot of your hedges roll off or they're at collars at much higher prices. This question asks specifically, are you going to be putting on new hedges? I'm going to add to it and ask, how do you think about hedges? Before, they were kind of something you would lock in to assure yourself to be drilling. How do you think about them now that we're at this type of price?
Yeah, you know, we typically look at hedges on a shorter term basis, you know, up to a year out. I think we've done up to a year and a half out at times. You know, we believe for a while the fundamentals looked strong and continue to look strong. They look stronger than probably what we were looking at. We will start layering hedges, I believe, into, you know, at least into the first half of 2022 here shortly, like back to that 1 year time frame. Again, we'll continue to be more collar directed to allow for upside and keep the low side in place. You know, again, at $60 WTI, we can run a fabulous company. So that's a good potential floor that we could be looking at. The other piece to the whole hedging is, you know, just that backwardation makes it difficult to go out too far. You know, you get to $64, $65 for next year and low 60s for the year after already. So, you know, we'll continue with the year and a half looking for those tuck-in hedges that we could do as we move forward here.
We got a question in here talking about NGLs. We tend to focus a lot on oil. Can you just talk about the pricing that you're seeing with both natural gas and NGLs?
Yeah, I mean, and NGLs can be very volatile. You know, we typically get on average between 35 and 45% of the WTI price when you blend propane, butane, and condensate and pentanes. Condensate and pentanes typically trade at a premium to WTI or Canadian MSW, Edmonton Light. And then the propane and butane, it has a whole bunch of different factors that change the pricing. But, you know, a few years ago, propane was poor and butane was strong. And, you know, we're kind of in the exact opposite of that right now, where butane has been not so strong and propane. So there's a lot of factors that go into that. But typically, on average, you know, let's say 40% of WTI price is the number, which is still quite a bit better than what you would get from, you know, keeping that and selling natural gas at a higher heat content, keeping it in some of that in the natural gas. So,
you mentioned your willingness to look at other tuck-in acquisitions. Are there really that many opportunities when we're talking this high level of oil prices? It seems to be when prices are low, that's when people are selling.
There are opportunities. You know, again, have we closed the gap between expectations? I'm not sure. We've seen actually a fair amount in the first quarter, and it's kind of slowed down now in Q2 and the second half of Q2. You know, there are opportunities, and I go back to, you know, one of the pieces that you're not seeing as much activity in M&A right now is the fact that, again, back to that access to capital. Not everybody can raise equity. Not everybody can add more debt to the balance sheet or increase their lines. It's not as simple as it used to be. And, you know, you think that it would be better in this price environment, that it should be better. But, you know, the lenders for our type of business set their price deck back in March, and they don't change it till the fall. And they stay pretty close to those pricing, which again would have been in the $50 range WTI. So you know, they react a bit slower. They're you know, after the last year, they become a little bit more conservative, and I think that's right across the industry. And that's why you're even in the U.S. I don't see the ability to you know, grow at anywhere near the rates that once occurred, because I just think people are asking for return on the capital spent, not growth for growth's sake. And the access to that capital isn't as easy as it was, you know, in prior years.
We've got one more question, and it's basically just asking if you're planning on increasing your capital budget due to strong price. I'm going to change the question a little bit and give you a chance to kind of sum things up by talking again about the next earnings release and the things you'll be looking at, and repeat the date for that release again, please.
Yeah, that's a good question. So yeah, when we release, like, we'll completely go over all our forecasts on the production side. We'll reprice the commodity pricing hopefully getting a better view of what will happen for the second half of the year, so we can make the proper decisions. I do think you'll see some creep in our capital. First of all, because we're drilling more expensive 1.5 mile wells versus the 1 mile wells, and if we drill more, 2 more and not the 1 mile wells with the greens, so that'll increase that. We're, as far as price creep, we have not seen price creep on services on our current drilling program. A little bit on the completions that are upcoming. Where we have seen it is on steel prices. So our tubular and our casing goods have increased, and we believe we'll continue to see that into the fall. And if the activity stays, or increases, I do think you'll see some more price creep and on the service side as well. So we'll have to take all those into considerations. What I always like to say is the fact that commodity prices over 70 will help absorb a lot of those increases that you may see here, but I don't see it being substantial. But you're going to see a little bit of that across the board.
And the date of the earnings release again is it the 14th?
Pre-markets August 11th is the current plan.
Thank you for joining us for this virtual roadshow presentation brought to you by ChannelChek. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and microcap companies.